Welcome to Zerodha Varsity Videos. I'm Astha Khurana and we are doing crash course on Warren Buffett's letters to his shareholder. In the previous episode, we discussed the year from 2002 to 2006 and we discussed some amazing acquisitions that Warren Buffett has done, and he first time did acquisition in foreign investments and forex as well. Apart from that, we discussed something around life settlement fund. Moreover, we did discuss that he had taken acquisition into real estate investments, and 2008 was the era of financial crisis. So we are going to see that how is Warren Buffett, Berkshire Hathaway, is going to manage during these financial crises. Also, in the previous episode, we talked about some amazing ground rules regarding corporate governance. In this video, I have with me Vineet and Satya from Team Varsity, and we are going to discuss the era from 2007 to 2011. In this episode, we will discuss that how from the year 2007, the stress has started to build up. In 2008, the crisis took place and there was collapse of Lehman Brothers.
Yes, in this era, the 2008 financial crisis or the Great Recession has been a very big event. During this time, or in 2008, while the Berkshire Hathaway has fallen by just 9.6%, the S&P 500 has fallen almost 37%. If you want to put this in perspective, say if you hold a stock of $100 back then, the S&P 500 would have fallen to $63, while the Berkshire Hathaway stock would have fallen to just 90.4. This makes a lot of difference, right? Because when the stock has corrected so much, when the markets recover, it has to recover from this low point. But Berkshire Hathaway had fallen only little. Even when the recovery happens, it has to start from this high point. It makes a lot of difference in the long run. Coming to the business economics, during this time, the insurance business and the utility business have done pretty well for the Berkshire Hathaway. Because Warren also said that these two businesses have less correlation to what's happening in the economy, and they've received a large float and they were earning interest on that float, which is not there for other insurance companies. Other than that, of course, because the economy was in doldrums during that time, the consumer and the retail businesses, which are directly correlated to the economy, were not doing well. Besides that, Warren is not very much worried about the stock market correction. He was referring to Ben Graham's quote that price is what you pay and value is what you get. And quote unquote, he was saying, whether it is a stock or a stock, I like buying quality merchandise at cheap prices. During this time, the popular quote, be fearful when others are greedy, be greedy when others are fearful, also caught fire.
So Berkshire Hathaway's exposure to real estate mainly was from Clayton Homes. Clayton Homes had two businesses. One was manufacturing homes and the other was giving home loans. Now let's talk about manufacturing homes. First of all, in the US, manufacturing houses or housing sales had peaked in late 90s, and since then the unit sales had been falling. So Clayton Homes was also seeing a decline in volumes. Of course, not as much as the industry, but they were seeing a decline in volumes. Moreover, their target market was the people from lower middle income or lower income group. So the stress was building up in real estate, and it was likely that these people were going to default on their payments. The second business was home loans. They were giving home loans to the people who were buying houses from them, or even to people who were buying houses from other builders. So yes, there was stress building up. NPAs were on the rise. Warren was also sensing that the business is in a little trouble.
So help me understand that the way you started talking about Clayton Homes, I thought you will be giving some relief kind of information, as if, this is how they tackled. But you've mentioned some negative aspects of how their businesses were not doing good. So how were they able to tackle this?
Well, Clayton Homes, in fact, fared much better than its peers. But let's first look at the build-up of what was going on in the economy and what led to this crisis in 2008. Firstly, the income levels were rising, and when people's incomes rise, they want to buy homes. Naturally, you would go to a bank and take a home loan from them. Now, these banks were competing among themselves. First of all, if you could afford, let's say, to buy a house worth $500,000, the bank was letting you take a house worth $1.2, $1.3 million as well. like much more than what you can generally afford. So how are you going to get this kind of a large loan? Is because banks were letting you take loans worth 95 to 98% of the house's value. You just had to give a down payment of 2% or just 5%. So you have to just give a very small amount and you get a big, large dream home for yourself. A lot of other people who were otherwise unable to afford houses also started buying houses. So the demand built up. More and more people wanted to buy houses, so housing prices were going up, and the banks were willing to lend to them. Now, if the loan amount was so high, how were these people were able to afford the payments? Here comes teaser rate.
Okay.
You're paying a very small amount in the beginning for the first 2 years, and 2 years later is when your actual payments would start. So let's say if your interest rate is just 5%, you will pay only 2% for the first 2 years, and the 3% that you're not paying is not discounted. It's being added up to your principal. So 2 years later, when you will actually start paying, you will be paying much bigger amounts.
Okay, so Vineet, I have two questions here. First question is that how are these mortgages different from the way we have EMIs in India?
So EMIs are basically equivalent monthly installments. It is an amount that you pay every month towards your home loan. This amount does not change with the changes in interest rates. Let's say you have taken a home loan with 8% interest rate for 15 years. Now, a few years later, the interest rates have gone up to 10%. So your payment tenure from 15 years would go up to, let's say, 18 years or 20 years, but your monthly payments will not change. That is equivalent monthly installments. That is how we do it in India. But in the Western countries, they have this concept of mortgage. If interest rates are going up, your monthly payments would go up. If interest rates are going down, your monthly payments would go down.
Okay, so the second question, as I said, I have two questions. The second question is that now understanding the difference between mortgage and EMI, you said that the banks were giving teaser rates to the customers. But what I don't get is when they know that initially they must be getting a lesser burden in terms of repayment, but ultimately that burden is adding up. So why are people, still having this kind of risk?
The banks were willing to give higher value as loan and only with a very little down payment. So that's the first reason. The second reason could be that interest rates were falling before the 2008 crisis, and it was not there in the people's mind that interest rates would go up in future and they would have to pay higher EMIs or higher mortgage payments in future. And the people who are selling these loans to home buyers, they also did not say it. They conveniently hidden it because they want their sales to go up. The third is, just as you mentioned, there were teaser rates, there were also interest-only loans. That is, if you see student loans, these student loans would allow you to pay only interest in the first few years, and from third year or the fourth year, from the time you get your job, that's from when you have to pay the principal also along with the interest payment. There were these interest-only loans that were given back then for home buyers. That's the third one. The fourth one, which is the most important, is the refinancing part. Now, there was this thing called cash refinance where you can exchange or replace the existing loan with a newer loan by going to a new lender. Say, Asta, you have a home worth 1 lakh rupees. You made a down payment of 20,000 rupees and you got a loan of 80,000 rupees. Say, after 1 year, you paid about 10,000 rupees as principal repayment. Your outstanding loan has gone down to 70,000 rupees. Now, since the house prices were going up, your house was now valued 1,50,000 rupees, say. Now you go to a different lender. I want a refinance on this same building. Now the second lender may give you the loan of up to 1,20,000. Okay. Now you have only outstanding of 70,000, but you are given loan of 1,20,000. The difference between this 70,000, 1,20,000, the 50,000 will go and sit in your bank. So you are getting more money in your hands as well. So this is, I think these are few of the reasons for the build-up of bubble in the housing industry in the US, and it's also the start of subprime loans. Where the money was given to borrowers with weak credit history and with high risk of default.
You know, this reminds me of the movie The Big Short, where I remember this guy walks up to this club dancer where she explains to him that I have 5 home loans, as in she has 5 mortgages, and this person wants to understand that how is she going to make the payment for them, because he doesn't believe that she has enough salary or income to, you know, fulfill the mortgages that are there. Then that dancer replies that my broker or my agent says that I could always refinance.
Right.
Exactly. Now, this is where all the trouble was building up. These brokers were only focused on selling their homes. If someone said that, oh, I cannot afford this, they would be like, oh, I have a friend, a local friend who can lend you for this. So there were these localized lenders who would finance home purchases. And they would not look at the borrower's profile or whether they could afford to pay the mortgages or not. They were just looking at whether this borrower can pay the initial teaser rate or initial interest rate for the first 2 years. They didn't care whether this borrower would eventually be able to pay it or not.
Right.
So why would a lender give out loans like this? Is because once they've given loans to, let's say, 1 lakh people, 100,000 people, they would pool all of it, package it and sell it to the bank. So they would immediately offload the risk to the bank. And why would the bank buy it? The bank would assume that this lender has done his due diligence and has acted with prudence in underwriting these loans. So the bank was depending on this lender, but the lender thought that it's not my risk to take, I'll just simply transfer it to the bank. So the banks were now sitting with a lot of loans to people who really could not afford those homes or those loans. So this is how the crisis unfolded. When the teaser rate period ended, or when when they had to start repaying the principal amount, these people went to the banks to refinance, and interest rates had started going up. So they figured that they were getting these loans at a much higher rate. Now they would have to continue with these mortgage payments. If they could not continue, they were trying to sell these houses. Now, a lot of these people together were trying to sell these houses. There weren't enough buyers in the market. So the house prices started declining. Mind you, here interest rates are going up. Initially, they thought that the interest rates would never go up. Because there are too many sellers and not too many buyers, home prices are going down, meaning real estate prices are falling. They thought they would never fall. And they thought that they could always refinance. Now, because the interest rates have gone up and there are no buyers of the house, the banks are also unwilling to give out loans. So refinancing was also stuck. Their incomes had also started stabilizing, or in fact, a few of them had started losing jobs because overall the crisis was building up in the economy. So all of this built up. Now, this led to the banks having NPAs go up to 10%, 20% of their overall assets. How was Clayton Homes saved from all of this? Mind you, Clayton Homes was giving loans to people in the lower income or lower middle income group, and their average credit score was lower than the average credit score of the US, of all of the US. So they had lower credit score, and still Clayton Homes did well. Why? Because Warren is saying that Clayton Homes was prudent in their lending practices. They were making these people pay 20%, 25% of the house price as down payment. So only 75, 80% was given as loans. That's point one. Point two is that they were not given teaser rates. Even when such a selling tactic was applied, it was only for 3 months or 6 months to get those people used to it. And in applying this prudence, Clayton Homes would look at a borrower's profile, would see that, let's say, this borrower has a monthly income of $1,000. So their monthly payment should not go beyond, let's say, $500 or $600. They should have about 40% of their monthly income to pay for other things in their daily lives. So all of these checks were applied, which is why, despite having lower credit score, these people continued to pay for their homes. Now, the banks were saying that their borrowers figured that the house prices had fallen, so they were better off not paying for the houses, and hence they had given up the houses and let the bank take care of those houses. Warren is saying that is not how it works. These people were lower middle income group. They wanted to be in the house that they had. It didn't matter what the market price was. It's really cumbersome for an average middle class family to just leave the house and go and stay elsewhere. These people wanted to pay, and these low credit score people could also pay. So it was the prudence at Clayton that helped them survive, and overall their NPAs were only 3.5%, not 10-20% like other banks were facing.
This is actually some crazy, amazing facts around Clayton Homes. But either of you can help me understand that how, since the crisis was a global crisis, of course it started in US, but it turned out to become a global crisis. How was India tackling this situation at that time?
The self-imposed restrictions that Clayton Homes had during that time, RBI made it mandatory for all the Indian banks during that time. So there is this New York Times article in which they mentioned the reasons. They talked to the chief executive officers of some of the top banks in India and reasoned out why India was insulated from such a housing crisis. Everything that was the reason for the bubble in the US housing industry were absent in India. That is, loans were given only to people who could afford them. There was no interest-free loans. Banks did not take more and more leverage. There are no complex products that are sold to people. And most importantly, there is no refinancing that's happening in India. Above all this, Indians were also not comfortable. Culturally, we are not very comfortable taking loan or having credit just as Americans do. So I think these are few reasons why India could withstand that crisis better than other countries.
So nicely put, Satya. But Clayton Homes had to pay the price for being the stronger player. So when a lot of financial institutions were facing trouble, they were on the brink of collapse, the US government supported them. They said that you borrow loans and we will guarantee your loans. Clayton Homes had not collapsed or was not even on the brink of collapse, so they did not need the government support. So the sick institutions who had government support could borrow at cheap rates because those loans were guaranteed by the government. Clayton Homes, because was strong and did not have the government support, had to borrow at higher rates. You know, when there is stress in the economy, private credit becomes expensive. So Clayton Homes had to borrow at higher rates than these sick institutions.
So Vineet, one last question that I have while we are talking about financial crisis and on 2008. Of course, the country had a major hit, the economy had a major blow. I want to understand is that how long it took for the economy, or as I say, the stock market to recover.
So when Warren is writing his letter for the year 2008, so it was already 2009, let's say February of 2009, he's saying that all of 2009, the economy is going to remain in shambles.
Okay.
And if any recovery, it will be in 2010 or maybe later. However, he's saying that Charlie or Warren, both of them have no view on where the stock market would go. They have no view on that direction. However, in 2009, again, when he's writing the next letter, he's saying that conveniently only half of our comment was taken and the other half was ignored. Media houses reported that Warren is calling an economic collapse, and people assume that I'm calling the collapse of the stock market, while he specifically mentioned that Charlie and I have no view on the stock market. Indeed, in fact, the stock market rallied. The S&P 500 outperformed Berkshire Hathaway.
You see, this also reminds me that this is a very nice lesson for the retail investors here as well, because at times we confuse the performance of economy with the performance of the stock market. They can go in tandem, but for at least a short period of time, there could be divergence in them. An easy example to understand could be the recent era of the COVID era. When the COVID hit, of course, economy fell down, the stock market fell down, but we did see that there was a nice V-shaped recovery in the stock market, but still, the economies didn't recover. In India, it took at least around 2 to 2.5 years to recover, and in Western economies took even more time to recover, which means that in the long term, ultimately, if the economy is growing, the stock market will grow. But in the short term, we might see divergence and we should be very careful about it.
So true.
Absolutely. I'm just reiterating what you said, Vineet, the Warren Buffett's quote, which is the economy could be in shambles throughout 2009, well beyond that probably, but it doesn't necessarily say whether the stock market will rise or fall. He said that. Coming to the business economy during that time, his return earlier that the insurance business is not correlated to the economy, but I think there is a correlation because in 2009 and 10, the auto sales have come down and there is a rise in unemployment and people stopped buying insurance. So insurance business was slightly impacted, and of course the retail business and the housing industry, we all know that it is directly related to how the economy performs when it comes to earnings and the economy of the business. Yes, they have been poorly performing during this time, and even the Berkshire Hathaway's market price, even that has been slightly underperforming the S&P 500. You see, in 2008, Berkshire Hathaway's book value has fallen lower than what the market has fallen. That is because they were holding higher levels of cash. We always talk about liquidity, how important liquidity is for Warren Buffett and Berkshire Hathaway. Because of those cash levels, it has fallen down. Now, because of the same cash levels, even there is a limitation when the prices were going up or the market was recovering.
So correctly put, Satya. Now I have 2 points here to mention. When the economy started recovering in the late of 2009 or 10, consumer businesses recovered faster than housing and related businesses. So here, let's say candies or furniture or jewelry recovered faster than real estate or businesses that were related to housing, such as bricks, insulation, rooftop carpets, etc. The other point that I want to mention is, like you said, cash. Cash is what limited their performance, and S&P 500 outperformed them. Warren did not care what the market prices were. He, in fact, used cash to his best advantage. In the 25 days just after Lehman collapse, they deployed $15.5 billion and supported a few financial organizations, when they were on the brink of collapse. So it was not only the hand of God or the hand of the government, it was also the hand of Warren Buffett that helped bail out a few institutions.
Wow. Vineet, if I may ask, as you said that he also had a hand in saving a few companies. What were those companies that he saved?
So in the 18 months after the Lehman collapse, they have supported 5 institutions and they've deployed $21 billion. These institutions were Goldman Sachs, Swiss Re, Wrigley, Dow Chemical and General Electric. Apart from that, they also invested in a lot of stocks. Plus, they also acquired BNSF, Burlington Northern Santa Fe. It is the largest freight railroad company in the US.
Oh, nice.
In fact, by reading the letters, we can see how proud Warren was by investing in these companies. One was the Mid-American Energy, which we discussed in the previous one, and also the BNSF, the rail company. He says these are the fundamental services that are essential for the community and also the nation indeed. He wrote that for a country to unlock its full potential, it requires first-class electricity and first-class railway system. There's another interesting bit. In every letter, he also invites shareholders to come to the AGM. So he said, hey, this year AGM is happening at so-and-so place. We would like all of you to come and join it. And he signed the letter. And below that, there is PS, come by rail.
I remember that. But let's move on and talk about other acquisitions or other businesses rather that they have gotten into this time. This is a very exotic, crazy product. It's called the tax-exempt bond insurance.
Okay. Let's first understand what a tax-exempt bond insurance is before we understand how Warren was investing into this business.
Yes, let's understand that. Imagine you are lending money to a city or a municipality. Now, the money raised by this municipality will be used in constructing schools, parks, hospitals, or fixing the roads. Now, because you lend the money, you will get some interest from this municipality. Now, because it's from municipality, it is tax exempt. Now, there is a risk that this municipality may default on repaying you the money. There was also this, a higher probability that was increasing at that point in time that municipalities could default the payment. That's when tax-exempt bond insurance has come into picture. Berkshire Hathaway will give insurance to this municipality that if in case the municipality defaults repaying you, that money will be paid by Berkshire Hathaway. In fact, bondholders back then were also preferring Berkshire Hathaway to be the insurance company, to give the insurance, because that's the credibility that the company has built during that time itself. But this is a very, very risky business for Berkshire Hathaway also. In fact, Warren was explaining this in his letter. Back in 1975, New York City was about to go to bankruptcy. There were so many wealthy people and institutions who invested in these New York City bonds. Because if New York City collapses or New York City municipality defaults, then all these the interest of all these people will be compromised, right? So because they don't want that to happen, so they all came together, they took some measures, they were ready to take some concessions. This is all because New York City bonds at that time were uninsured. Here, what if they were insured? Now they would think that, okay, fine, there is somebody else who will repay if this defaults. The collective efforts will not come into picture if it is an insured bond. And mind you, if one municipality defaults, it's a cue for other municipalities also that they could default and the money will be paid by the insurer. So it's a very, very risky business that Warren has entered into, and he was referring to this as a business which is close to insuring natural catastrophes.
That is what I was thinking, that the way Satya has explained about the insurance of something which is very risky, and something like this can also have a domino effect. Like one municipality starts defaulting, the other could also do the same, that we don't have to do the work, we have insurance company to pay for us, why do we have to work? But the point is that why Warren is involving himself or his business to such risky bets?
Risky it was, but you're forgetting the name Ajit Jain here. So Warren and Ajit would evaluate these kind of businesses, and if they saw that the price was justifying the risk, they would just invest in it. So they are saying, we have looked at the pros and cons and the price is justifying the risk, we will invest in it. That is not all. They're also getting into another risky bet, that is they were selling credit default swaps.
Really? What is the credit default swap now?
This is again an interesting concept, but of course a very risky one. Credit default swap, as the name suggests, is transferring the credit default from one person to another person. Say, Asta, Vineet has approached you, asked you for a loan. You've given 1 lakh rupees, but you doubted Vineet could default in future. Will you do that? Now you had a small doubt that Vineet could default in the future. Now you come to me, Berkshire Hathaway could be, and say that I want an insurance. I am transferring my credit default to you. For that I am paying some premium. But if Vineet defaults, you have to come and pay. That's how you came to me. So I take up that business. This is the credit default entered into. This is also a very risky business. It's just an insurance, but it's also kind of a risky one.
The product is risky, but Warren has measured the risk. The economy was in doldrums around that time, so all organizations had taken a hit. That does not mean all of them were going to default. Warren would analyze these businesses. He saw that these managements were competent enough to pull these businesses back on track. It is for this that he would invest in these kind of businesses, right? So he has written CDSs on 42 different corporations and taken a risk worth $4 billion here. However, he could not scale this business further because there were collateral requirements, and he did not want to furnish more collateral. He did not want to block his capital in unearning assets, which is why he limited the scale.
I mean, hats off to this man who can take this much amount of risk. I mean, I can't even imagine it. So now that we are talking about acquisitions, and you did mention in the agenda that he has finally entered into tech stocks, why don't we talk about that?
Sure. So there are 3 investments that they have done. We are discussing it in this period, but 2 of these investments were made in the previous period. Why didn't we discuss it in the previous episode? Because Warren did not disclose it in those letters. He's disclosed it now in 2007, 8, etc. So first is BYD. It's an electric car company based out of China, and Warren Buffett was a very early investor in this company. And how we know that he's invested in this is, like we know in every letter, he's explaining how the AGM is going to be. He's giving out the logistics, the exhibition and sale that would be set outside this AGM. So he's saying that when you come here for the AGM this time, for the year 2008, you will see on display a BYD electric car.
And that is how you know they were invested in it?
Yes, because he's not disclosed the amount or the time when he's invested in this.
Oh.
The second is a bet not only on technology, in fact, it is more on the debt or the financial strength of this company, Amazon.com. He picked about 390 or something like that, 390 million roughly, in euro-denominated debt of Amazon.com. He's saying that at the time Amazon was rated junk, but it was anything but. They had a very strong balance sheet. And again, Warren was playing on USD depreciation against Euro. Now, these two, in fact, were kind of pseudo investments. The main investment, the big bang investment, was IBM. He's invested $11 billion in 2011 in IBM.
You said IBM. I thought that, you would mention any one of those FANG stocks because as I remember, FANG stocks had become a big thing by that time.
But they were relatively new in technology. And Warren is saying that I have been tracking IBM for the past 50 years. So much for a no-tech policy, he had been still tracking this business. The past 50 years, he had been reading their annual reports. He's saying finally in the March of 2011, his thinking crystallized and he thought that he should invest in IBM. He's saying it's not what you look, it's what you see. So finally he saw the value in IBM and now he's investing in it.
He also said that it would be one of his best decisions investing in IBM. He endorsed IBM because he saw that the company has laid out all the goals for it in the future and it knocked down. So looking at the history and looking at the fundamentals of the company, Warren really thought that this company could do very well for his business in the long run. Of course, it's another story that he sold significant amount of stake in IBM in future years, but I think it's for
the future episodes.
Future episodes as well.
Now that we are talking about his acquisitions and investments, you would have noticed that since the end of 1990s to now, there is a slight shift in Warren Buffett's investment style. For example, they had started taking alternative investments. Of course, now they have grown a lot in size, so their asset allocation allows for these kinds of alternative bets as well. However, there's also a change in the strategy. For example, we know that he's a long-term investor, but he's also taken a timely bet. In 2002 to 3, he's accumulated $488 million worth of shares in PetroChina. He's saying this was a timely bet. Warren and Charlie are thinking that oil prices are going to go up, and they think that PetroChina, that was valued at around $37 billion at that time, would go up to $100 billion. So they've invested $488 million there. Come to 2007, PetroChina did perform well, oil prices did go up, and PetroChina's market cap went up to $275 billion, and they have exited this investment at $4 billion.
This is really crazy, but then it says a lot about Warren Buffett. I think the man's eccentricities have all of a sudden changed from being a forever investor to taking timely bets now.
It's not transition from long-term investor or the forever investor to taking timely bets. If you see his investments, asset allocation is designed in such a way that his core portfolio in Berkshire Hathaway, he's investing in long-term investments or having a long-term investment horizon. For his satellite portfolio, I think this is what I'm assuming, that for this satellite portfolio, he's taking all these timely bets with PetroChina, etc. If you see for PetroChina, at the time of investment, his book value, the Berkshire Hathaway's book value was $77 billion, and you said that he has invested $488 million, right? That would come to only 0.6% of his entire portfolio. Satellite portfolio, to give you an example of what a core and a satellite portfolio is, say you have only 100 rupees savings, that's it, okay? You also come across a very interesting microcap. There is a risk that this microcap can lose the entire money, but there is also a risk that it could be a multi-bagger for you. Will you invest the entire 100 rupees in that? May not.
I mean, my greed will say yes, but practically no.
Practically no. You may invest only 10 or 20 rupees in this microcap stock, but you will have this core portfolio which will give you long-term decent returns. You will, dabble with only the 20 rupees for the high return, high risk investment, so that it could give a leg up to your entire portfolio. So this is called the satellite portfolio, the money in which you have used to buy the high risk bet investment, while the core portfolio is the stabilizing one for the entire portfolio.
I like how Warren Buffett has used this strategy to manage his such huge corpus, but this is also, I believe, a learning lesson for retail investors as well, that when you are into asset allocation, satellite portfolio can be one of your strategies where you do not disturb your core portfolio, but you can have those timely bets, those risky bets that you want, but it will also ensure that you don't blow up your entire capital, and whatever thrill that you want to have in stock market can only be played by a small amount of satellite portfolio or the risky bets that you want to play. But this also strikes another point, that this does not mean that, just for the sake of it, you just go and gamble away your money. For satellite portfolio as well, you need to have time, you need to have enough research, you need to have enough background and effort so that that satellite portfolio is actually making money for you and you are just not gambling it away for the thrill.
Now, core and satellite, or let's say asset allocation between equity and debt, you have to basically set a return expectation from your portfolio. Warren is saying, or he's in fact criticizing pension funds for having a return expectation of 8% from their portfolio. Pension funds are expecting their portfolios to grow at 8% in the long term. Warren is questioning, is that really possible? Now let's take that with an example. Now let's assume that all of pension asset funds are worth 100.
Okay.
He's saying 30% is invested in debt and 70% in equity. Now for this 100 to grow at 8%, it should deliver 8 at the end of the year. This 30 will grow at roughly 5%. So this is just 1.5. 5% into 30% is just 1.5. This will add up 1.5 worth of total returns. The remaining 6.5 has to be delivered by this 70, which turns out to be 9.3% of annual growth. He's asking, can your equity portfolio grow at 9.3%? In fact, why is he asking this question? Is because all of 20th century, the Dow Jones Index has grown 5.3% only over the 100 years. Add to it 2% of dividends, that's 7.3%. It still does not add up to 9.3%. Mind you, this 9.3% has to be after tax. He's asking, can your equity over the long term grow so much for these pension funds to have 8% returns? If not, then don't expect your portfolio to earn 8%.
Time and again, we keep telling retail investors, this is a reminding point, that you need to set your expectations right. Of course, you want to earn more money, but having, unachievable or undesirable expectation is something which is going to harm your portfolio. To put it in example, the way you have given this example, that if you are investing into an instrument and the equity market is going by 15%, but your asset allocation, as we say, should be diversified, and if 30% of that portfolio of that is gone into debt, then it does not mean that your entire portfolio can grow by 15% just because equity is growing. And also, mind you, while we are talking about return expectation, there is one more thing that needs to be factored in, that is cost. The cost of acquiring that asset, or maybe the brokerages or the commissions, the taxes that you're paying. Net, whatever you get is your return expectation, and that should be in tandem with where you are investing and how the equity is performing, and that is how you set the realistic expectations for yourself.
Talking about the cost, Warren also talks about how the passive investors or the passive investments have to outperform the active investments in the long run. He calls passive investments or passive investors know-nothing group of people. If you say passive investments, it could give you an average return, but it also has lower costs attached to it. So even after removing or excluding that cost, you will be retaining that average return. When you go to active investments, of course, you have a probability that you would earn higher returns, but that also comes with higher costs, higher brokerage commissions, or higher other associated costs that come along with it. Warren says that after these costs, whatever you are earning would be much lower than what a passive investor would do. That's why he's saying that in the end, passive investor or know-nothing investors have to win.
Now that we've taken so long to sing the songs of their glory, let us also enlist a few mistakes that Warren is confessing to in these years, that is 2007 to 2011. The first two are mistakes that he did because he did not talk to Charlie about it before committing those investments. The first is ConocoPhillips. It was a similar bet like PetroChina, where he thought with the growth in oil prices, ConocoPhillips would deliver good returns. He's saying, I did not consult with Charlie on this, and it turned out to be a sour investment. The second is at the peak of global financial crisis in 2008, he invested $244 million in two Irish banks, thinking that these banks would revive and would deliver good profits. However, within a few days, his investments lost 90%. And again, he's saying, I did not listen to Charlie. He says, next time I will talk to him.
I don't know when is he going to listen to him.
And the third mistake is Geico credit cards. Geico had a large customer base. Warren wanted Geico to capitalize on that by upselling other products and making money out of it. He's saying that the others at Geico were not very excited about Warren's proposition, but he asserted his stature of being older and wiser. And it turned out that this business was, in fact, a bad decision. They lost massively on this, and they eventually sold off the credit card division at a big loss. He's saying, it turns out I was just older.
And not wiser.
Yeah.
Vineet, now that you've talked about Warren Buffett's mistake, the thing that I like is that this man is taking in, he's owning up to his mistake, not someone who runs away, because he understands that other people, other investors can also learn from his mistake. And the next best thing that I like about him is giving due credit to Charlie Munger. Whatever his investing philosophies are, the way he has imbibed them into Berkshire Hathaway are really commendable. And we have seen him, shifting, whether it was about that plane or whether it is shifting from Ben Graham's philosophy to a long-term philosophy. I like how Charlie's ideologies have become an integral part of Berkshire Hathaway.
In fact, yes, we have been seeing how Warren always credits Charlie, that this is how he's suggesting that we should do this, or this is how we thought about doing that. Around this time, he's crystallizing all of it into Charlie's guiding principles. He's saying how Charlie's thinking is applied at Berkshire. He's taking a few pages in these letters to enlist how Charlie guides them. Firstly, so we'll talk about 4 points. Firstly, Charlie is saying, never invest in business whose long-term prospects you cannot evaluate. For the longest time, they did not invest in technology because they could not evaluate the long-term prospects. They are saying we did understand that autos, airplanes, TV, such businesses in the long run, these were going to do better for mankind and that these sectors were going to grow. Everyone knew this, but no one could predict how competition was going to decimate all the earnings power that these businesses would have. So which is why they were not investing in these, and they want to stick by it. If they do not understand the earnings prospects of a business, they will stay away from it, they will not invest in it. Second, they will never believe that they are too big to fail, which is why they maintain this $40 billion of cash pile with them, because they want to be ready whenever a liability comes calling or whenever there's an opportunity to deploy cash. He's saying that all of this money is earning pittance for us, but it lets Warren and Charlie sleep peacefully at night, and they would like to have that sleep.
Right.
The third is that they will never supervise or monitor a business very closely. They will let the managers run the businesses, run the operations in their own manner. Berkshire will not try to impose its systems on those managers. In fact, this kind of a hands-off approach sometimes means that there is a problem in a business and it would be a long time before Warren or Charlie would observe or come to know about it. He's saying we are happy to bear the cost of this hands-off approach, but we will never bring bureaucracy to stifle innovation and independence of our subsidiaries.
How nicely put.
And fourth is that they will never try to woo Wall Street. By that, he's saying that they will never try to show better quarterly earnings. They will only focus on long-term growth. They do not want to invite traders owning their stock. All they want is long-term investors to stay with them as partners.
How amazingly Charlie has put these principles for Berkshire Hathaway, which also says so much about how they have been performing, how they are performing, and how they will be performing, which is really amazing.
I really like how Warren puts every important subject into 4 to 5 points. Do you remember the 4 important principles before selecting a stock that Warren and Charlie?
Yes, we discussed them in the very, very first episode. That first one is that you need to understand the business, simple business that you can understand. Second is around earning prospects, that you can see good earning prospects. Third is around managers, that there should be good managers that run the business and credible managers that run the business. And fourth is the most important point, that the business should be available to you at an attractive price.
Since you both enumerated few points, let me also enumerate one point about what Warren and Charlie focuses on in a business during the bad times as well as the good times. Of course, it overlaps with the points that you already said, but these are the 4 points that they're saying that they'll always have focus on. The first is liquidity. As you mentioned, they're comfortable having higher liquidity because they think that this liquidity will help them sleep well in the night. The second is the third point in your list, which is the management. Yeah, they always want to have expand and nurture the outstanding managers that they have in their businesses. The third is a very important term. It's about having a competitive advantage in your businesses. The fourth is having varied streams of earnings.
Streams of earnings, Satya, that is something that reminds me how Warren would categorize investments into 3 broad categories. The first category was cash. It is what would provide for liabilities and opportunities whenever they would arise. Second is unproductive assets like gold. When you hold gold or any unproductive asset, these assets won't yield any dividend income or interest income. And the third is productive assets. Let's say you invest in a stock, over the time that you hold, it grows in capital value and it also delivers dividend. Now Warren is saying that this productive asset class is their favorite, and it also provides the best hedge against inflation over a long term.
But Vineet, gold is also an asset class that is considered to beat inflation, right?
Well, Warren would disagree, and he explains it this way. Let's say around that time, if you put all the world's gold together, it would fit in a room that was 68 by 68, and it would be worth $9.8 trillion. Compare that with, let's say, you use this $9.8 trillion to invest in, let's say, companies. You could buy 16 ExxonMobils with this $9.8 trillion and still be left with $1 trillion for your liquidity needs. He's saying 100 years later, these 16 ExxonMobils would have delivered trillions of dollars in dividends and would have grown in capital value, while this pile of gold will still be a pile of gold. Over these years, you earned interest and dividends. It helped you grow. It helped provide for your other annual expenses as well. So is gold really a good hedge for inflation? So Warren is saying that equity or productive assets in the long run are a better hedge against inflation than gold.
Yeah.
Right. When you were talking about moat, and when you were also saying that, you get dividends from companies, and while talking about moat also you said that he's invested in such companies which give him dividends. I feel that how ironic it is that he's expecting dividends from the various businesses or stocks that he has invested in, but he himself is not giving out dividends.
So 2 things here, Asta, moat and dividends. We'll take them both separately. First is moats. Let's understand what moat is. It is a competitive advantage that a business has. Now, you as a business or me as a business, we would have different qualities that would set us apart from the rest of our peers. Let's say you are a pricing leader. So for example, DMart in India or Walmart in the US, they are price leaders. They sell at deep discounts. How they do that is by setting stores in the suburbs of the city where real estate is cheap. And then they buy in huge bulk quantities, which allows them to give customers discounts. Now that is how they are setting themselves apart from their peers. Another would be, your moat could be brands. So in fact, Warren said that they would like to buy businesses that would buy commodities and sell brands. For example, Coca-Cola. What commodity are they buying? Sugar, water. What are they selling? They're selling Coke. Now, if you were to compare Coke and Pepsi, no one compares them for taste. It's the aspirational value that counts, for Coke. It's how you feel when you have Coke. So it's the brand value that Coke has created over more than 100 years of existence.
Right.
Another moat could be having cost controls over your business, or having very efficient manufacturing operations. For example, Berkshire Hathaway was invested in Acme bricks. Now, no one goes and says that, oh, my house has Acme bricks. No one cares about the brand of bricks in their houses. So why was Warren invested in this, or let's say a cutting tools company, is because they were very strict with their cost controls. Their management efficiencies were very well in place, and that is how they were able to deliver profits. And those profits were then transferred to Berkshire Hathaway as dividends. Now, Warren was happy to not receive dividends if these businesses could continue growing. For example, BNSF, the railroad company, for 5-6 years at least that they've invested, after they've invested, they continued to invest more and more in BNSF because they were building more railroads, they were updating their systems. But let's say See's Candies, where they are profitable, they are delivering dividends, but if they're not giving out dividends, what would See's Candies do? They would invest and they would grow their stores. But Warren could see that scaling up was not going to help them. So this business was better off giving dividends to Berkshire Hathaway, whereas BNSF, while it was profitable, was better off investing all of its profits back into the business.
Dividend is usually considered a reward to the shareholders. While Berkshire Hathaway back then in 40 years haven't paid any dividend, they've rewarded their investor through another form, which is buyback or repurchase. Usually these buyback of shares, which is company buying shares from the market and cancelling it. These buyback of shares happen at a price slightly higher than the market price that is prevailing at that point in time. So for those investors who want to exit the company, buybacks give a better price than what the market does. This is also beneficial for the existing shareholders because once the buyback happens, say there are 100 outstanding shares in the market, 20 were bought back by the company. So there will be only 80 shares left in the market. So the whole earnings of the company will go to only 80 shareholders now compared to 100 back then. The share of the existing shareholders go up. That's why Warren, he wanted IBM prices to, be trade at lower prices so that IBM can go for stock repurchase because Warren Buffett is an existing shareholder back then, his stake will improve.
Okay, Vineet, while we are talking about dividends and we also discussed that Berkshire Hathaway did buybacks, can you help me understand that why Berkshire Hathaway was comfortable with buybacks and not dividends?
So let me take it with an example, how Warren is explaining. Let's say the three of us are Berkshire Hathaway shareholders, we can only assume, and all of us own 100 shares each. Now, if Berkshire Hathaway were to announce a dividend of, let's say, 50 per share, the three of us each would get $5,000 in our accounts. Let's say you wanted that dividend for your needs. I wanted some money, but not $5,000. I maybe wanted just $2,000. Satya does not want any dividend. She wants this money to keep growing. Dividend imposes one benefit for all the three of us, while all the three of us may be having different investment journeys and different needs with this money. Share repurchase allows the three of us to act on our independence. You want money worth $5,000, so you will sell shares to Berkshire Hathaway in that repurchase and get $5,000 for yourself. So I'll sell shares worth just $2,000 and she will not sell anything because she wants to hold on to it. This is the flexibility that investors get in a share repurchase, and dividends don't allow you that. Now, the other point that I wanted to mention about buybacks is Satya also mentioned that when the market price was very close to the book price, Warren is saying that they would engage in buybacks only if the market price is 1.2 or 1.1x of the book value. Basically, the PB ratio has to be 1.1 or 1.2. Anything more than that, and they will not engage in buyback. Anything less than that, and they will aggressively do buybacks. They started doing this in 2011, and they have continued to do that ever since.
Finally, we have reached down to our final and last segment. Vineet, in the previous episode, when we were discussing the last segment, we did touch upon the succession plan, but we were so close to giving names. So, who is it now? Please reveal it. Drum rolls.
Well, I will give you the names, and after that we'll just discuss two letters, not the shareholder letters, but two letters that Warren is talking about in these letters. Yeah, so let's get to the names. Warren has announced that Todd Combs and Ted Weschler, these two candidates, will be investment managers. They've started with $2 billion each. Both of them will have their own independent way of investing and delivering returns. So these are the two names who would succeed Warren in the investment operations. They've identified a CEO, but they're not disclosing the name. They've also identified backup candidates for the CEO, two backup candidates. But he's saying that we will not disclose these names for the fear that they might be poached by other organizations. And we still have no information about who's going to be leading their insurance operations. Now let's talk about the two letters that I'm saying. The first is a letter written by Ernest Buffett, Warren Buffett's grandfather, to Warren Buffett's uncle. In this letter, and with that letter, his grandpa gave $1,000 to his uncle, and he's saying that whatever little that I understand of business through running the grocery store that they had been running, that this kind of an emergency fund of $1,000 helps them whenever there is an emergency need. While you could have various investments or you could have your own business, however it is going on, you need to have this liquid cash with you to be able to pay for any family emergencies that come up. And in fact, he's saying that from their personal experience, this money was useful at least thrice. Whenever they used it, they quickly replenished it as well.
No wonder Berkshire Hathaway is maintaining a very high liquidity of about at least $20 billion. The liquidity is not for emergency purposes, but also because Warren wants to buy at cheap prices. He wants to use this money when there is a market correction. In 2008, as you mentioned, just in 25 days after the Lehman Brothers crisis happened, Warren Buffett, through Berkshire Hathaway, had invested $15.6 billion.
You know how nicely the letter that the grandfather had written about emergency funds, and how nicely Warren Buffett has used that example, that the value of that letter, into something in his business. This reminds me of the fact that this is also often said that finance discussions should be a part of dinner table conversations. Because when you have those conversations, you, from the very childhood, are instilling the knowledge of finance, the basic concepts that will help kids when they grow up. And the way Warren Buffett has grasped that value which was given to his grandfather and, imbibed that in his business, having that dinner table conversations regarding finance is a must do to have right now.
Truer words were never said, Astha. So let's move to the second letter. Now, this is in fact a memo that Warren has written to all his CEOs of the subsidiaries. There were about 76 of them around this time. And it's a long 2-page letter. I'll just summarize it into 4 points. The first point, he's saying, if there's a problem, tell me immediately about it. I would like to tackle them as and when they occur, not when they've festered for a while. 2, if faced with a decision whether to do it or not, and your associates are saying that everybody is doing it, so let us also do it, but you think that it is out of line, consider that it is out of line and don't do it. This is the third point. Berkshire Hathaway is a large organization now. They have 250,000 employees. Warren is saying somewhere someone is doing something wrong. If you spot an act of impropriety, act on it immediately. He's saying culture is what defines how an organization behaves, not rule books.
Right, very right.
And fourth and the last point, Warren is asking all his CEOs to find a successor. He's saying in a letter to me, write the name of the successor and explain why you think they are a good replacement for you. No one will read these letters. Just label them as personal for Warren and only I will read it. Now that's about it. I have been talking a lot. Why don't you two summarize what we've discussed in this episode?
Wow, what a crazy episode this was, with so many major events taking place. So the first thing that I liked in this episode was around liquidity and emergency fund. The way Warren Buffett is, was talking about his grandfather's letter, the way he has talked about why having an emergency fund gives him the benefit of dealing with liquidities, finding opportunities, emergency situations. So I think that is a very big learning lesson for the investors as well, who start their investment journey immediately without having an emergency corpus, which is a must-have.
Yeah. For me, I really liked about how the asset classes were divided into 3 categories. One is cash, unproductive, and productive asset classes. It really changes the perspectives on how you look at it. Gold is an unproductive asset class. It doesn't give you anything. The pile of gold remains the gold after a few years. But the equity will create so many other companies in future if you have invested in it. I like the perspective in which these asset classes were looked at.
Nice. The second thing that I really liked about, and which is very important for investors as well who are looking for investment opportunity, is moat. Moat is something that provides you an edge, a competitive advantage, or we can say as USP. So the way Warren has talked about moat by saying that you buy commodities and sell brand, and that is also in itself a moat. He has Coca-Cola, See's candies in those target investments. So for retail investors as well, if you come across an investment which is buying commodity and selling brands, that is a really nice moat. You should actually harness upon that opportunity.
Yeah, the second point for me is about the passive investments. He talked about how passive investments, because of its low cost, even if they are giving the average returns, will still be average, the return that you would have be average. But the active investments, which are giving higher returns, but because of the costs that are involved in it, will give you returns lower than those average returns delivered by passive investments. He termed those investors as know-nothing investors. I like how he says that people who are dumb when they know their limitations cease to be dumb.
Talking about returns, I really liked how Warren Buffett was talking about pension funds and the way he taught us how to set right expectations for your returns. And, it is very important for retail investors to understand, since you have a diversified portfolio, what asset classes you are investing in, what returns they are giving in. You need to factor all these things, and then you also need to factor that what is the cost attached to it, and based on that, you need to set realistic returns.
Finally, asset allocation has to be talked about. He always want to maintain high liquidity so that he could use that during emergencies, as well as when market correct, use that opportunity to buy more equity. Also, how there is a core portfolio and the satellite portfolio, and the satellite portfolio he uses only for taking high risk bets, but the core portfolio he maintains it for his long-term investments.
Wow, so we have come so far in this journey. We've reached episode 7. We have discussed the letters till the year 2011. There is so much we have learned. There is yet so much to learn. So see you in the next episode with amazing learning stories from Warren Buffett and his letter. Do tell us in the comments section what were some learnings that you had or some interesting stories that you really liked. See you in the next episode. Thank you so much.